Hello, welcome to the European Open briefing for Monday, April the 30th. I'm Rafi Bajan, currency analyst at XM.com, and we're going to be having a look at the latest developments in the currency markets today. The US dollar has pulled back slightly from those highs it achieved on Friday, following stronger than expected US GDP growth. The euro managed to bounce back somewhat, having slumped to 3.5 months lows. The pound also fell sharply on Friday after UK GDP missed expectations. The Aussie and the Kiwi ended Friday higher, ending a long losing streak, but both are under pressure again this morning. The Canadian dollar managed to recover as well on Friday after hitting 3-week lows, but is also struggling again this morning. And we can see the dollar moving upwards as we get into the European Open. Euro and pound slightly weaker. The Aussie and the Kiwi are one of the worst performers this morning against the US dollar. Gold prices are also down, despite the fact that 3-year Treasury yields have pulled back from those highs, about 3% last week, the 10-year yields that is, and oil prices are also down this morning. We can see, though, overall we have positive risk sentiment with most major indices all in the green, and this is being helped by that summit between North and South Korea on Friday, where the two leaders agreed on complete denuclearization of the Korean peninsula. So let's get started with the US dollar. We can see dollar yen failing to break above the 109.50 level. We can see dollar yen rally appearing to stall still since Wednesday last week. On Friday, it briefly spiked to 2.5 months high, 109.53, before reversing lower at the moment. It briefly fell below the key 109 level. At the moment, it's managed to recover to around 109.20. Dollar index hit a 3.5 months high of 91.99, just below the key 92 level. But lower 10-year Treasury yields are weighing on the US dollar, despite the fact that on Friday we saw US GDP growing by an annualized rate of 2.3% in the first quarter. This was better than expectations of 2%. We've got more important data coming up later today. We've got the personal income and consumption numbers, which will include the core PCE price index, which is the Fed's preferred measure of inflation. That's expected to edge up to 1.9% in March, close to the Fed's 2% target. On Wednesday, we're going to have the FOMC decision, and on Friday, we've got the April jobs report. We're also likely to see trade coming back onto the agenda. We've got the steel and aluminium tariffs, the exemptions, temporary exemptions that some countries got for this. That exemption is due to expire tomorrow on May the 1st. The key, Canada and Mexico will likely have their exemptions extended, but it's not clear whether or not the European Union will see its exemption extended. If it doesn't, then the EU could then retaliate by imposing its own tariffs against the US, and that could once again lead to the escalation of trade tensions. Also, the Trump administration is sending a trade delegation to China, including Steven Mnuchin, Larry Kudlow, and Peter Navarro. So they're expected to go to China later this week to discuss how to diffuse that trade tension, which had led to a sharp rise in risk aversion earlier this month. Let's take a look now at European currencies. The euro recovering significantly from 3.5 months low of 1.2053 touched on Friday. We can see that sell-off from last Thursday after the ECB meeting. It now appears to be comfortably above the 1.21 level, though we did see disappointing German retail sales numbers, leading to a bit of a sell-off, a small sell-off a short while ago for the euro-dollar pair. We've got some important Eurozone numbers coming up later this week. We've got the flash GDP for the first quarter on Wednesday, and on Thursday it's going to be followed by the flash inflation reading for April. The pound, though, didn't manage to recover from those 2 months lows, $1.3745 touched on Friday. UK GDP growth, unlike the US, disappointed, growing by just 0.1% during the first quarter, missing forecast of 0.3%. So this means that a rate hike in May is now looking very unlikely, with futures markets pricing in just a 20% probability of a tightening at the May meeting. We also didn't see much of a reaction to the resignation of the UK Interior Minister, which happens to be a close ally of Prime Minister Theresa May. Sterling at the moment is trading around 1.3750. Let's move on to the Australian and New Zealand dollars. If you look here in the charts, this is the daily view. We can see Aussie pretty much retreating since the start of the year. The Kiwi dollar had been fairly flat up until mid-April before we can see that very prolonged slump. The Aussie touched the 4.5 month low of 0.7530 on Friday. The Kiwi fell to 4 months low of 0.7037. We can see though that long losing streak was ended on Friday with a positive close for both pairs, but both are under pressure this morning. We did see though less than expected drop in Chinese manufacturing PMI for April, and we saw an improvement in a non-manufacturing PMI. That didn't do much for the Australian dollar. Also, we did see some Australian data as well. We saw private lending numbers, which were positive in March, but not much reaction, not much help to the Aussie from that either. And the Kiwi though, we did see a drop in New Zealand business confidence in April, so that clearly is weighing on the Kiwi. Looking now at the Canadian dollar, it's doing a little bit better. We can see resistance there for USD CAD around 1.29 level. So that was 1.29 exactly was a 3-week low for the loonie on Friday. It did manage to recover slightly before weakening again this morning. Overall optimism that there will be an NAFTA deal as well as higher oil prices are helping the loonie, which is performing slightly better than the Aussie and the Kiwi relative versus the US dollar. Oil prices continue to consolidate though. They remain close to those 3-year highs. We did see the US rig count on Friday showing the number of active rigs last week in the United States rising to the highest since 2015. That's weighing on prices this morning. Also, we are seeing Britain, France and Germany pushing for a new nuclear deal for Iran. So such a deal would likely mean that if the US wouldn't impose new sanctions on Iran, so that would be negative for oil prices, since we wouldn't see a supply cut from Iran. So that's why we're seeing oil prices lower, more than 1% lower this morning. WTI crude trading at around $67.35 a barrel. Looking at today's economic calendar, we can see the numbers there released already. We've got German flash inflations coming up shortly, but the focus will be later on US personal income consumption and core PCE price index, as well as pending home sales and the Chicago PMI. That's it from me. Thank you very much for watching and have a great day.